You're gonna hear me say this a lot. You guys are gonna get sick of this. You guys out there might get sick of this, but I don't care. When we trade options, more often than not, our goal is not to exercise the contract.
Hey, I'm Desiree.
And I'm Denver.
Welcome to Options Trading Essentials, a video series dedicated to teaching you the ins and outs of options trading. In this episode, we're breaking down an options contract. Now, the language of options can feel intimidating, even for seasoned investors. From calls and puts to exercise and assignment, there's a lot of lingo.
That's why it's important to have a solid grasp of the language and mechanics of options contracts before you get started.
Exactly. So in this episode, we're going to walk through the basics. We'll talk about options contracts, including the rights and responsibilities of buyers and sellers. And we'll teach you some of the key terms you should know.
And later on, Kendall and Obi will walk us through an options chain using the Robinhood mobile app. But first, let's answer the most basic of questions. What is an option?
A stock option is the right to buy or sell a stock at a set price on or before a specific date in the future. There are two types of options, calls and puts. Owning a call option gives you the right to buy stock. Owning a put option gives you the right to sell stock. Options are financial contracts, and like any contract, they come with terms and conditions. The buyer of an options contract has certain rights, and it's up to them whether or not to enact or exercise those rights, but they're not obligated to do so. While options buyers have a choice of whether or not to exercise their rights, options sellers don't have as much flexibility. Instead, options sellers are obligated to hold up their end of the deal based on what the options owner does. And in return, options sellers collect a fee or premium for selling those rights. Each option contract has terms that help buyers and sellers know exactly what they're agreeing to. These are called contract specifications, and they uniquely describe that option. Specifications include the option type, a call or a put, the underlying stock, the strike price, and expiration date of the contract. Obi, tell us about contract specifications.
Every option has contract specifications. Options are standardized, and there are 4 key specifications that can identify any option that you're looking at. Let's break it down. So here I have an example option. It's the XYZ October 22nd, 2021, $75 call. And I've also put in parentheses because, of course, for every call, there's also a put. Now, let's break down what we're looking at. Here at the front of the option, we have this symbol XYZ. This is what we call the underlying. And if you hear us talk about the word underlying in this series, we're referencing the stock or ETF or product that the option is tied to. What about this date, October 22nd, 2021? Well, this is the option's expiration date. And what's important about this date, it's the last day you can trade or exercise the option before it expires. Now, the third thing in this option is this number, $75, and this is the option's strike price. This is the price in the case of a call option. The buyer of the option can exercise the right to buy shares at $75. If it was a put option, it's the price that the buyer of the put option has the right to sell shares at. And so in every option, there's going to be a strike price. Now at the end, as we've alluded to, there's 2 types of options, calls and puts. And this is what we call the option type. So those are the 4 main specifications that you'll see across every option. Now there's 2 other specifications I want to bring up very quickly. The first is what we call the contract multiplier. And what's important about any option you look at is a standard option controls or gives you the right to buy or sell 100 shares of the underlying, in this case, XYZ. So, and I'm going to put in parentheses typically here, because there are some options that as the result of a corporate action like a stock split or a merger and acquisition, their options might be a little funky and they might not control 100 shares. But in this series, when we talk about options, we're generally talking about standardized options that control 100 shares. And the last thing I want to point out is exercise style. Now, we're not talking about a workout here. We're talking about how and when you can exercise your right under the contract. And we call this two different terms, American and European style options. Now, this has nothing to do with where the options are traded. They're just a way to label the type of option you're trading. So for example, if this option, the XYZ October 22nd 75 call, was an American style option, that would mean we can choose to exercise it if we were the buyer of that option, to exercise it on or before October 22nd. If this was a European style option, we would only be able to choose to exercise that option at expiration, which is October 22nd. So there's a key difference there. And it's always important to know, depending on which underlying you're trading, it might be a European style option or an American style option. But the takeaway here, guys, is that every option has four main specifications: the underlying, the expiration date, the strike price, and the type of option, a call or a put.
Did you know, back in the day, a centralized marketplace for options didn't exist? Not to mention, each contract was unique and its terms and conditions were non-standardized. This made things messy. As a result, there was no real market for trading options. That all changed in 1973 when the Chicago Board Options Exchange, or CBOE, opened its doors and was the first exchange to list standardized exchange-traded stock options. CBOE was an exchange with humble beginnings. Its first location was in the Smokers Lounge of the Chicago Board of Trade, and on the first day of trading, only 911 contracts were traded. By standardizing contract terms and creating an exchange to support efficient trading, CBOE helped the industry take off. Fast forward to 2020, the total average daily volume of option contracts traded was more than 29 million contracts per day.
In this episode, we've covered many of the components of options contracts. Let's run through the options chain. Denver, can you show us?
Yep. All right, let's do it. So I'm gonna select a random stock here. We got Microsoft. We click on the trade button, select trade options. If you look to the top, there are multiple expiration dates. I'm gonna randomly select the 3rd. So at right below that, you'll see buy and sell. You'll see call and put. And there's a lot more information here, but I really want you guys to contextualize for me.
Yeah, the first time someone looks at an option chain, it's a lot. There's a lot of information here. I love analogies. You guys are gonna get sick of my analogies, but an option chain, it's kind of like the menu at a restaurant, right? You show up to a restaurant, you get the menu, and you see everything that you can choose, right? Option chain is kind of like that. It's gonna tell you sort of every option that you can trade for any given underlying stock.
All right, well, Obi, you showed us a little earlier all the four elements of a contract specification. Kendall, do you think you can dive a little deeper on each of those items?
Yeah, absolutely. So Denver mentioned we've already selected our expiration date. So you select that expiration date at the top. Every contract that's populated below here now has that expiration date that you've selected. So that's one of our elements. Now we're looking to the left-hand side and we have our strike prices there. So if you can scroll through, you can see the variety of strike prices. For this one, for Microsoft, we're jumping around here, about $2, $2.50 differences between those strike prices. So those are your strike prices of your contract. A little reminder there of what type of contracts you're looking at. So we're on the call section here. If you were to toggle over to puts, that would then change. You'd have your strike and it'd say put as well.
So guys, I noticed one other thing. It looks like the share price is in the middle of everything. Explain the placement here. Does it change?
So just to really scratch the surface, it's a good call out. The share price for that underlying security, so in this case, Microsoft, will jump around your page depending on where you are in the options chain. If you're looking at Microsoft, for example, right now, you'll notice that the share price listing is right in between the strikes of the 292.50 and the 295. So it's right sandwiched in between those, and as you scroll, it will move around your screen.
Okay.
So something to think about when we're talking about the element of strike price on an option is sometimes you might see strikes that are a dollar wide. So it might go from, say, 50 strike to the 51 strike. You might have half strikes for some stocks. You might see $5 wide strikes. So when you're looking at a strike price in the option chain, just know that different options have different widths of the strikes between them.
Yeah, and kind of wrapping up the basics of this page here. So we mentioned the strikes are on the left, a lot of different numbers here. On the right side, you'll notice those values that are actually could be changing depending on what chain you're looking at. In this case, we're looking at Microsoft. We kind of touched on liquidity a little bit in those high market cap securities. This is one of them for sure with Microsoft. So a little bit more liquidity there. There may be a little bit more supply and demand for these contracts, which is why you may notice that the premiums on the right-hand side during active market hours are fluctuating. So you're seeing those prices change, and that's the premium, which is representative of what are people buying and selling these contracts for in the market? What's their value?
I see. So there's a lot of supply and demand at play and kind of like what people want, and that'll change the price.
Absolutely.
Oh, you are foreshadowing. You don't even know. We're going to talk a lot about that later, but knowing where the stock is relative to any given strike price is a huge detail. And it's going to determine a lot of things in terms of, as you mentioned earlier in the video, Desiree, whether someone would choose to exercise their rights to buy shares if they owned a call option, or choose to exercise their rights to sell shares if they owned a put option. But more importantly, and you're gonna hear me say this a lot, you guys are gonna get sick of this, you guys out there might get sick of this, but I don't care. When we trade options, more often than not, we're actually not too concerned with exercising our rights under the contract. Our goal is usually to buy an option at a certain price and sell it at a higher price, just like we would with stock. Or if we're the seller of an option, we want to sell at a high price and buy it back cheaper, or even let that contract expire worthless. So I just want to plant that seed in everyone's mind.
Got it. Well, I'm definitely going to get familiar with the options chain. It sounds very important.
Once again, this is your menu.
Yeah.
And as you choose a strategy, it's going to involve picking your underlying stock. Which expiration date do you want to trade? Which strike price? And then more importantly, are you trading calls or puts? And that's just the beginning. We still have to decide which strategy we're going to employ, which we're going to talk about in future episodes.
I was gonna say there are so many cool things that you can do here, but definitely don't want to overwhelm you. Let's start with the basics, and we're gonna dive into all the other information in more depth for sure. On the next, options trading essentials. When you own a call option, you want the underlying stock to go up in value.
Meanwhile, sellers of call options are typically bearish. They're hoping the price of the underlying stock goes down.
You're a beginner, you're thinking in the money, that's a good thing.
Yeah.
It depends.
Thanks for watching the video. If you enjoyed this episode, smash that like button and leave a comment. And don't forget to subscribe to the channel to get alerted when new episodes become available. Remember, options involve risk and are not suitable for all investors. Before trading, check out the link below in the description.